Hey guys, thanks for coming. I hope you enjoy this as much as I will. First of all, I take no responsibility for this course other than a year ago I knew exactly as much as you know about accounting and sustainability. So I kind of came on cold, so I'm not the sustainability expert, I'm an accountant. So keep in mind that this is accounting, not sustainability today. So what this course is, it was a 2-credit-hour course. And it was cross-listed. That's why there's 2 numbers. It was listed to MS Accountancy students and MBA students. And about 1/3 of the class was MBA students, and about 2/3 of the class were MS Accountancy students. And here's kind of a snapshot. I took numbers off the slides because there's 42, and I didn't want to scare you. I was going to leave them on so you could see 39, 40. You know we're almost over. But most of these I flipped through quickly. But here's kind of the content of the course. We started off by setting the stage. Then you can see we talked a lot about external reporting. In external reporting, we talked about the Global Reporting Initiative, the SEC and the EPA's disclosure requirements, what's generally accepted accounting principles for the FASB and international accounting standards, greenhouse gas accounting reporting, carbon disclosure project, and cap and trade schemes. Then we talked a little bit about sustainability measures as an input to investment decisions. And then we ended up talking about sustainability reporting at Notre Dame. I know Heather was here yesterday, and so I'm just going to touch on that for a minute because she wasn't necessarily interested just in the reporting, but in all the wonderful initiatives that are currently going on. So with that in mind, this was setting the stage. So this was the first day. And this is not Bill Nichols because I'm an accountant. I'm not a business ethics, corporate social responsibility guy. But what we did was we talked about what's corporate social responsibility, what's sustainability, what is sustainable management, what is sustainability accounting and reporting, and what's the motivation for issuing these reports in the first place, these sustainability reports. Then, I'm an accountant, so how many people have had an accounting course in here? Most everybody? Yeah. Okay. So, if I was teaching sophomore level accounting, I guess it's been a while, but I think I would start off, I'll look at Janet, something like this. There's this real world that I don't know a lot about, but it's out there, and we make all these assumptions about the world. There's this entity assumption, what report, is it the owner or is it the business? It has going concern, time period, unit of measure. But the accounting function is, over here, is to look into the real world and look at all these financial events and then identify what events I should report to decision makers, how I'm going to measure those events, and how I'm going to communicate them. And so, kind of the accounting process is communicating relevant information to decision makers. And we've got all this gap, these generally accepted accounting principles that tell us, what to report, how to measure it, and how to communicate it, in the notes to the financial statements or as a line on a balance sheet or income statement or statement of cash flows. So we've got all these generally accepted accounting principles that have evolved over several decades. Then, for decision makers, we all have internal and external decision makers, managers, and then these other people outside, these other peoples and groups. And we've put together general purpose financial statements. So we assume that this balance sheet, this income statement, this statement of cash flows, these notes to the financial statements, the auditor's opinion, the management discussion analysis, all these things will serve the purpose of all the external users, and the system will generate data for the internal users, the managers, okay? And we've always looked at external users as, shareholders, creditors, government, customers. So we come up, with something that looks like this. Anyone that's ever known me, all I do is talk about Kellogg's. I'm from Battle Creek. So, you come up with a Kellogg's annual report or the 10K from the Securities Exchange Commission, okay? So that's what I know about, and that's what is my passion, to admit it. Some people like baseball. I like financial reporting. So the next thing I feel, what is sustainability accounting? How is that different? And so it's different. It's still looking into the world and trying to identify, measure, record, report to stakeholders. And I changed it, you know, stakeholders is a pretty broad category. But now it's just not the economic area. It's broader. It's economic, environmental, and social. And, you know, something that people kept telling me as an accountant, you know, what you can't measure, you can't manage. What you can't manage, you can't change. And that's why we've got to, you know, start looking at putting metrics onto some of these sustainable issues. But unlike the first slide, there is no SEC or FASB or International Accounting Standards Board that promulgates generally accepted principles for reporting. So now I'm left in a pickle here. I've added, Matt, is there any way this, Matthew, is there any way this thing shines a light? Is that, I thought you said that goes blank. Oh, no, never mind. There it is. No, hey, thanks. Yeah, so now it's not just economic, but we've got environmental and social events, but there's no entity that tells, you know, what events shall we identify, how do we measure them, and how do we communicate them to decision makers. In other words, the decision makers now become not just those list of individuals, but they're individuals or groups, they can be groups, who affect or are affected by the organization's activities. So like the city of South Bend is affected by the activities of the University of Notre Dame. And we have no idea of what the general purpose statements look like. We don't know anything about the format and content, and we don't know anything about the level of assurance, because those of you who want to be accounting majors may well go to work for a CPA firm. And again, you know, PricewaterhouseCoopers, you know, provides a level of assurance to these reports by being their independent auditor. Okay? So we've got this internal reporting for sustainability, and we do some of these things. I mean, these data are used to support strategic management decisions, and you know, I've got some of these reports come out regularly, like the monthly worker injuries or volumes of waste report, which is used internally to manage strategically sustainability. We've got other things that are issued one time, like let's say we're going to build a dam and we're going to therefore flood an area. Well, we need to know what is the impact on all those groups that are affected by that. You know, people that get displaced, lands that are flooded, wildlife that may or may not survive. But all this stuff's really interesting, but that's not the focus of this course, okay? I'm not into managerial decisions within the firm. That's not my area of expertise. So really what I'm interested in is the external users, and some of these reports are required. You know, we know that the 10K is required, the annual report. There are disclosures about environmental issues there. We know the EPA require emissions data. We know there's compliance reports, like in intermediate level accounting, on the funding status of a defined benefits pension plan, and also minimum wage. And there also may be voluntary, unregulated. Hey, guess what? Here's Kellogg's sustainability report. Actually, it's 105 pages long, and the executive summary is only 21. And because they're sustainable, they won't give a hard copy of the full report. But anyways, so there, you know, Kellogg's has got their annual report, and they also voluntarily supply this report about sustainability. So what are the best practices right now? And then we're going to run through these quickly. Well, the best practices for external reporting are you use the Global Reporting Initiative, which we'll talk about in a minute. They set the standards to measure and what is included in the report. So it's like GAAP. Then to integrate environmental, social, governance, and financial disclosures in the 10K and annual report. And that's kind of the way we're going, is into integration. Actually, Prince Charles has a commission set up in the UK that's looking into this integration. Then reporting your greenhouse gas emissions to the Carbon Disclosure Project is a best practice. And then again, a great practice is to engage your stakeholders on a periodic basis to find out if you're really reporting the type of data they need to make decisions. So the O10K, the GRI, and the Carbon Disclosure Project. I haven't yet, that's from KPMG data, and I can't find anything newer than 208. But in 2008, 79% of the global 250 were issuing corporate sustainability reports. 77% were using the GRI. We've got more current data. In 210, there's over 2,500 companies reporting to the Carbon Disclosure Project. And we'll talk about that in a minute. And in 210, the SEC issued new guidance on climate change and risk disclosures in the 10K, which went into effect last February. So those are the best practices. So the GRI for a second. It was formed in 1997. It's a nonprofit housed in Amsterdam. Its mission is to develop and disseminate globally applicable sustainability reporting guidelines. And we're currently in version G3, generation 3, and it was issued in 2006. They've done G3.1 and G3.2, but those are just tweaking. The bigger one will be G4, which is currently being worked on. This is used by organizations. It's used by Kellogg's when it prepares its sustainability report, and it speaks to the environmental and social dimensions of their activities. Okay? In fact, there is Dean Wu is on the board of NiSource, and NiSource put their first sustainability report out this year, and they're using Global Reporting Initiative reporting standards. In fact, she's on the board of directors, and I believe she's on the Safety and Sustainability Committee. In fact, I think she's chairperson of that committee. During 2009, catch this, during 2009, there was 1,389 organizations issued sustainability reports using the GRI, okay, of which Kellogg's is one and NiSource is one in 210 now for the first time. But here's the thing that should blow you away. 131 of those are U.S. corporations. So only 10% are U.S. corporations. So the story here is the action's not in the States. The action is outside of the States, in particular in all the EU, in Australia, Japan, Canada, but not the U.S. The U.S. is way, way behind in this. So this is the de facto standard for reporting. This is the gap for reporting sustainability. You can go to the website and you can download an Excel spreadsheet that lists all these companies, their business, where they reside, all kinds of things, and then it gives you a link to every one of their sustainability reports. Okay? I didn't download the 210 because I had that data from the class. I apologize for not updating it. So the GRI Generation 3, they have principles tell us how to report and disclosures on what to report. And so, what you've got here is the GRI. You've got these principles. So now it sounds like the first class in accounting. The qualitative characteristics of accounting data. It's got to be representationally faithful and timeliness and all these other things. So they've got all that too. So this content quality boundary is a lot of the stuff like in the conceptual framework if you had accounting. So it sounds like an accounting course. Then boundary just tells like what are you reporting? All the entities you control. So the boundary could be huge. You own 5% of a company, but you don't include their sustainability efforts. But if you own 80%, probably. So it's like a consolidation in a financial accounting course. And then we've got standard disclosures. Now these standard disclosures are going to be the strategy and analysis of the company towards sustainability, the organizational profile, the report parameters, in other words, what period of time is this covering, how many entities, subsidiaries are being included, and then something about the governance, commitment, and engagement. This is all text. It's not very sexy. This is where the action is, okay? Disclosures on the management's approach, and these are actually metrics. They have indicators, metrics, performance indicators for economic activity, environmental activity, and social activity, okay? So that's what, that's what turns me on. So I'm all the way back here. Now I've got a world I can deal with. I've got the real world. I've got economic, environmental, and social events. Now I've got, from the GRI, I've got general principles that talk about the content, quality, and boundaries of the report. Then I've got these performance indicators which tell me, okay, in environmental, here is an indicator you have to measure the performance, and here's the metric to use. Okay, so it might tell you, how many metric tons of CO2 equivalent were emitted during the year. And how does that compare to the prior years? And then now we've still got the same stakeholder group over here, any individual or group that's affected or affects the company. But then the general purpose financial statements, well, now I know what goes in these guys. And it's almost all disclosures. We don't have a balance sheet and an income statement. It's almost all disclosures. So it's text with numbers in the text. So it's like you're reading a disclosure on a pension or a lease in Kellogg's annual report. And the disclosures are the strategy and analysis, the organizational profile, the parameters, the governance. But then there's long text explaining these measurements that come from over here. So they talk about the economic performance and talk about these measurements and how the company's performing. So with all that in mind, don't get blown with this. Will be quick. The GRI says there's 5 steps. Some of you have seen this before. The GRI had 5 steps. And so we didn't talk about all of them. I mean, we did a little bit. If you're going to come up with this report, like Kellogg's did, then the first thing you got to figure out is how does Kellogg's, their activities, how do they link to sustainability? And so you kind of use something like the United Nations Global Compact to figure out these are sustainability issues. How does Kellogg's affect? What type of activities do they have that affect human rights? Okay, what type of activities they have that affect water, the usage of water? And so that's you go through that. Then connecting's really slick. We spent some time on it, and that is, you got to figure out who are your stakeholders. Who are Kellogg's stakeholders? The city of Battle Creek is certainly one, because if they leave, everyone else is left. It's a ghost town, okay? Certainly, I own Kellogg stock. I'm a stakeholder. Employees are stakeholders. The families of employees are stakeholders. It goes on and on and on and on. There's many stakeholders that benefit through the philanthropic gifts of Kellogg's. So then you have to dialogue with the stakeholders to figure out, what type of data do they need to make their decisions. Then you have to prioritize them because some are more important than others. The W.K. Kellogg Foundation owns 30% of the stock. They're an important stakeholder, okay? Very important stakeholder. Then we have to define what goes in, the content of the statement. What goes in that? And here we have to select performance indicators, go through things like we talk about in Principles of Accounting Materiality Tests, figure out in the sustainability context and in completeness and boundaries, these are kind of these conceptual framework things, is this report complete? Then monitor, we have to put together a system for collecting the data, ensure that there's quality to the data, and then improve our metrics. Then we actually have to write a report and send it out. So we got to choose how to do it and declare the application level, which we'll talk about in a minute. And I highlighted that because external assurance, we have to figure out, are we going to have PricewaterhouseCoopers audit our sustainability report? I mean, PricewaterhouseCoopers audits this guy and makes a couple $1 million doing it. What about this guy? And if PricewaterhouseCoopers audits the sustainability report, what level of assurance can they give to stakeholders of the quality of the data? Because this stuff's a lot different than, looking at the balance and confirming an inventory or accounts receivable. Okay, there's a whole different world here. And what we did in class, and it really worked out well, was a young partner from Deloitte who just got moved from the corporate office on governmental affairs, she was transferred into sustainability about 6 weeks before our class started, and she video conferenced in and talked about sustainability, what Deloitte's doing in this space, and where they think the future is going in this space. She did a really good job. And I wrote Kellogg's here just to remind myself a couple things. We also had a video conference in for part of one class, the person that was the head of corporate communications when it deals with this report. First of all, I said, why are you in the Office of Corporate Communications and not Investor Relations? Is this a marketing thing? Or what? And she said, no, because we have many stakeholders, and Investor Relations only has fewer stakeholders. They're mostly shareholders. And she brought some interesting things forward. First of all, they are preparing their third report right now. That was their second report. And one thing she said that I thought was really interesting was, or one thing they did was, they outsourced almost everything. I mean, I'm thinking Kellogg's is a big company, but they outsourced to consulting firms, identifying the stakeholders, having surveys sent to them, having focus groups with them. They outsourced the writing of the report. And so she managed all this, but most of it was done because they didn't have the expertise to do it. And interestingly, PricewaterhouseCoopers was involved in almost nothing, which shocked me because when we talk about the Carbon Disclosure Project, they're big shots in the Carbon Disclosure Project, and Kellogg's reports to Carbon Disclosure Projects, but was not involved at all in writing the report. So now, so I wanted to say what I want to do now is spend some time talking about the performance indicators. So here's what the GRI does. It takes these three buckets, economic, environmental, and social. And social, they break down into four other buckets. Labor practices, human rights, society, and product responsibility. And the GRI says, here's the aspects within those categories. I didn't know what the word aspects means. I went to Battle Creek Central High School. And so I looked it up. It's the nature, qualities, and characteristics of categories. So these are looking within these categories. What are the nature, qualities, and characteristics of things in economic? Well, a lot of them are just the economic performance of the company. They make money, they lose money, that type of stuff. There's also the indirect economic impacts that they're having, the market presence. Like Kellogg's, how much hiring do they do locally? Not only intellectual capital, but materials and labor versus, have it shipped in from another state or another country. Then environmental issues. They have all kinds of things about materials, energy, water, biodiversity. Then in this area, social, which is the most foreign to me, I can understand that. I kind of can understand that. These are softer things for me to understand. But in the areas of labor, things like employment, occupational health and safety, training, diversity, human rights would be investment and procurement practices, child labor, society, community, public policy, corruption, product responsibility, customer health, so on and so forth. So there's 34 aspects. From those 34 aspects, they're going to have 79 different measures of these different aspects, okay? And by the way, it was interesting talking to Kellogg's when I look at product responsibility, because they're coming out with their report last year, and they got a problem. And they had to address it, and had to address it in a way that was proactive. And the problem was they'd bought a hell of a lot of peanuts and put them in their Keebler cookies. They own Keeblers. And they had salmonella. Remember that big deal that happened? And so they had to recall all those cookies, destroy all those cookies, and try to explain to the public why they didn't monitor their supply chain as well as they should. So these types of data are data that have to be disclosed under the GRI and addressed. And they did a really great job. Jeff? Heck, yeah. I get paid by how many questions I have to disclose the overall effect of the health of cookies on people. But you have to disclose, no, you have to disclose what type of controls you have on suppliers and the quality of the product you're getting from them. So it's a product safety type issue. Yeah. Well, yes, they have to disclose that. They have to not. One thing about the GRI, I should say, is the GRI doesn't make any judgments about good or bad. Just like, you know, no judgments are good or bad. A financial analyst judges that. So it's a reporting, but you have to report about your labeling and that type of stuff as one of the GRI measures. And then it's someone else's decision whether that's nutritious or not. But that's a huge issue to Kellogg's, is nutrition. Jessica.
Quick one, I hope. But are the groups that are now just starting to provide assurance on these reports, are they using the GRI? Like, who's training the people to evaluate?
Yeah, no, there's, I think as we know, there's only one, to the best of my knowledge, there's only one firm, U.S. firm, that has an auditor's report for assurance, and it's UPS, United Parcel. And UPS, in their latest sustainability report, there's a level of assurance. I am not an auditor, so someone help me out. It's like what I used to call, when I was an undergrad a long time ago, it was like negative assurance. Like, you know, we looked here and we didn't see anything bad versus, you know, a positive thing where we did this and la-di-da-di-da. So, so Deloitte, excuse me, it's a UPS is a Ernst & Young, I think Ernst & Young client, and they have a auditor's opinion attached to. Okay? Now what I'm told from the auditors is the big action right now in that space, they keep using that word, in that space the big action is two things: setting up systems that gather these data, because most companies don't gather. I mean, if you ask Notre Dame, what's your carbon footprint for travel? Hell, I don't know. I have no idea. If faculty are going, staff going, flying all over the world, I don't know what it is, because we don't have, the HR system doesn't collect those type of things. And so they're setting up systems, especially for carbon, because carbon's where the action is. That's driving so much. Okay? And then the other thing they're doing is helping companies prepare to do these reports. Not necessarily going to audit them, but they help them systematically go through the process. The next step is, when they're more comfortable, that's maybe they'll have some assurance services. Yeah, Sandra.
Answer to Jessica's question. So you said E&Y is providing these services, assurance services, for sustainability report?
Whoever is UPS's auditor, I think it's E&Y, actually issued with this year's, for the first time, report an auditor's opinion. Bang, it's right there.
Do you know if the auditing, did they use an expert on sustainability, or did they train the auditors to do this job?
I don't know. And by the way, that's a talk about assurance. There's several of these that have assurance, but they're not CPA firms. They're a consulting firm that gives a level of assurance. So it's a non-accounting firm. But given the legal liability surrounding, you know, accounting assurance, they're probably a little more cautious.
The other question, do you know if it was assurance?
Yes.
Okay, not a full assurance.
No, not at all. Yeah. It's called negative assurance, and it's like a limited assurance. Right. And I said something to Dave Raschuti. I said, yeah, wow, did you see this? It's a negative assurance. He said, what the hell are you talking about? That's a 35-year-old term. And I said, well, that, you know, it's when I took accounting. So these 34 aspects, there's actually 79 performance indicators associated with them, okay? And so I just said, I'm only going to stick you with one. So each one of these 79 aspects has a protocol. So they've got a book that has like 3 pages to each one of the 79. And what it does, the protocol tells you why this measure is relevant. It tells you how to compile it, what's the compilation. It defines the terms, if any. It tells you what documentation sources you should either have or put in place. And then it gives you references. So just give you one example. I just yanked up labor practices. And in no particular reason, just grabbed that one, 10. So under training and education, this is really easy to understand. We've got average hours of training per year, per employee, by employee category. So I'm just going to look at what's the compilation guide, what are the documentation sources. So the compilation guide just says this. You know, what you do is you identify the total number of employees in each category. Well, what are the categories? Well, look how your HR is set up. Like at Notre Dame, it would be exempt, non-exempt, faculty, whatever, okay? Those types of categories. Then within the category, you figure out how many hours of training that individual had that period. And I underline training because they go into a long list of things that are training. So meeting with a subordinate and talking about self-improvement is not training. I mean, it has to be training that has to do with their professional activities. And so there's a thing. And then all they do is a simple ratio. You know, here's the number of employees in that category. Here's the total hours. You get an average. And so, you know, here's an accounting number that you report. You could audit that number, but a lot of these you can't. Okay? Then the references, say, okay, here's all the references you can go to figure out how to define things, how to look at things in that area. I have no idea what the ILO is, but I assume it's something to do with Human Resource Development Convention. So anyways, it gives you the references, my point. Okay? So for every one of the 79 indicators, and some of them have to do with things you hear about all the time in the news, like the relation between salaries of women and salaries of men. Okay? Turnover by ethnic background, gender, whatever. So I mean, they do all kinds of data in this labor relations. As an accountant, one of the things you report is, do you have a defined benefits pension plan? Because I guess they think that that's socially responsible because your company's taking the risk of paying retirement benefits into the future. So this, you know, back to here, because I'm going someplace here, back here, damn it, is at the end, you know, you've got to figure out what you want this animal to look like and how complete it's going to be. So that's what they've got is application levels. So you can have a C, a B, or an A. NiSource with Carolyn Wu is a C. It's the first time they've done it. Kellogg's is a B, and Dow Chemical Company happens to be an A. So before I talk about that, and then C plus, B plus, and A plus just means, hey, there's some external assurance. So, you know, it doesn't have to be a CPA firm, but someone's come in, looked at this and said, looks to me to be correct. GRI correctly applied consistently. Now, what these things are is just looking at how much data here are reported. So this just has to do with more data. For instance, if you're going to have a C, then you only need 10 performance indicators. One from each of the groups at least, economic, social, and environmental. But if you want to be an A, then you've got to have every core indicator. Like there's 30 core indicators. And so this just gives you more and more data that have to be disclosed. And so again, the GRI says nothing about the company's impact on society. All the GRI report does is it gives you a template, it gives you a format, principles, and the more complete the data disclosure, the higher. So an A could be the worst citizen in the face of the earth, but they just tell everybody that they are. Okay? So this is on disclosure completeness, not on quality of citizenship. Okay? So the next thing is, we're finally done with the GRI. Any questions? The next thing is that we looked at the Form 10-Ks, you know, which is the SEC annual report. You file the SEC. And under Regulation SX, there are data about the environment in the description of business risk, legal proceedings, which is Section 101, 103, risk factors, and management discussion and analysis. So we kind of went through and looked at those data. But then the big thing is that effective last February, the Commission, the SEC, issued more guidance on, hey, guys, you've got to do more disclosures on environmental issues, in particular in these areas. So if you weren't already doing it, then we want disclosures about the impact of existing and pending climate change legislation in areas where you have operations. So it doesn't have to be the U.S. Regulations, treaties, and international accords. Also, they seem to talk about disclosures about risks. So indirect and direct risks and opportunities. So that's the new thing. So, hey, the climate change is offering GE a heck of a lot of opportunities, in turbines, wind, in water, purification. And so tell me about the opportunities also, and then the physical impacts of climate change on your facilities, physical facilities. Also, there's EPA disclosures. The big new ones are out supposedly next month. Any entity that sends more than 250,000 metric tons of CO2 equivalent into the atmosphere has to start reporting with the EPA. Interesting debate currently in Congress, because if you've, well, I'm sure you haven't, but if you, hopefully maybe some of you have, if you're following this area, what's going on right now with the budget conversations is that they may, oh yeah, this was passed by Congress, signed by the President, but the budget may not put the funding in to monitor and do this. Okay, so that's an interesting conversation right now. And then we've got, hey, there's one of our classes. So we actually have U.S. GAAP, okay? U.S. GAAP and IFRS, International Accounting Standards, actually has some rules that affect that affect environmental issues. One would be contingent liabilities. Okay, so contingent liability, guess what? British Petroleum, huge contingent liability. The oil spill, April 20th, 2010. Second quarter annual report was issued on June 30, 2010. The stock price, market cap went from $180 billion to $90 billion over that period of time. That's the market making an assessment of how bad off things are for BP. Well, if you're an accountant, if you've got information available prior to the issuance of financial statements that indicates it's probable that you got a liability and you can measure it, then bang, loss, bang, liability, okay, on your financial statements. So, you've got those types of issues. That's an extreme case. But you also have just cleanup issues in general. You've been identified as a potentially responsible party at a Superfund site that has to be cleaned up, okay? And then there's asset retirement obligations. That means that normally we, in accounting, say, okay, we got cost minus salvage value is the amount you depreciate. But hey, salvage value is sometimes negative, not positive. In other words, here's the cost, but it's going to cost a hell of a lot more than I would be able to sell it for because of some environmental laws to retire the asset. In other words, if it's a pipeline in Alaska, I got to take it down and remove it from the state. Because Sarah's, protecting that state, Mother Grizzly there. The offshore drilling platforms have to come down. If you do strip mining, you've got to put back the overburden and plant trees. So the salvage values are negative. So they add to the cost of using the asset. And so those are issues. We did a case. And this was really an interesting case. I wrote it, but to me it was an interesting case because the stock price went down, $90 billion, and you got to issue the second quarter statements. The Wall Street Journal had articles in it saying, the market's nuts. There's no way this is going to cost $90 billion. Buy BP stock, okay? And so, what do you do? And then, Hayward had already set aside $20 billion, in an escrow fund for the states. And then when they set it aside, when they record the loss they did record, they reduced the loss by the tax rate, assuming that they could deduct this on their tax return as they incurred these costs. So is this really an asset? If it's a fine, it's not. But if it's normal cost of doing business, it is. So, they're trying to figure out, were they going to be able to deduct that or not? Because Congress is saying they may pass a law that said that it was so heinous the way that they were taking care of this property that they're not going to let any of it be tax deductible. So anyways, I enjoyed that. Greenhouse gas accounting. So we're talking about emitting greenhouse gas into the air. So we talked a bit about the source of greenhouse gas, the impact on the environment, which I know is an issue where there's some difference of opinion. Here's the reasons we said that you may want to track and report greenhouse gas. So in Kyoto, you have to, okay? In a lot of states, in countries, you have to. So, but again, I'm an accountant. So we're really, by the way, if anyone wants these slides, just tell me, I'll send them to you. Greenhouse gas accounting and reporting standards, these things are something. So this is a joint project of the World Business Council for Sustainable Development, I think it's out of Geneva, and the World Resource Institute, which is out of Washington, D.C. And so they came up, and they got together, and they developed, okay, in 1998, they launched, actually they didn't, they were established in 1998, and they developed standards for reporting and measuring greenhouse gas emissions. So it was published in 2004, and it is the standard. This is the standard that tells us how to do this. It's used by the GRI. So when the GRI is looking at environmental issues, they're using this protocol, they're using this document to figure out how to measure these things. It's used by the Carbon Disclosure Project, by ISO, which certifies, what's it stand for? International Standardization, I don't know, organization. But they have, ISO 1000, ISO 4000. It's a certificate that a company gets because they have a certain level of excellence. The EPA, this is how you report the EPA. And this, I don't use the word cool very often. It's not in my vocabulary. They got some really cool Excel spreadsheets here. So for instance, you can download an Excel spreadsheet, and you can take the University of Notre Dame's jet and punch in, how many trips it went on, how far it went, and it'll tell you the carbon footprint and any other greenhouse gas that were emitted. You can punch in, if I'm going to Salt Lake City and I'm flying coach, it'll be different than if I'm flying business or first class because there's fewer seats and I have to share more of the carbon footprint. If you're transporting, Kellogg's is transporting by rail from Battle Creek to San Leandro, California, frosted mini wheats, you can figure out what was the carbon footprint. If it's a diesel truck built between this year and that year, it's a different carbon than this year and that year. I mean, it's an unbelievable detail. So I had a lot of fun with that in class, and several people stayed awake. This is kind of the interesting thing is, I'm teaching this class in November. Give me a break. I'm teaching this class in November. Hot on this, greenhouse gas emission. Why? Because, it's where the action was, We had strong incentives for a low carbon generation society. We had disincentives for high carbon fuels. We were somewhat the beneficiary of the new administration's commitment to energy-related dollars for stimulus. Carbon pricing was likely. In other words, there was going to be like cap and trade. The new administration showed strong support for renewable energy. Well, what happened? That's what happened. There was November 11th. You know where I was November 11th? I was casting my vote in Niles, Michigan. And there was a change in administration. Okay? And so the one that really shook me up was, we're watching the U.S. Congress committee on energy. It's on energy and commerce, I think. And with the change of administration, there'd be a change of leadership. And at that time, the person that was lobbying among his fellow House of Representative members was John Shimkus. Now, listen to this. You know, I'm trying to teach about how important this greenhouse gas emission is. I'm trying to talk about, you know, cap and trade in a minute. So he opposed cap and trade. He said he believed that there was an issue with carbon, but he said, and this is a quote, "But God will not allow the earth to be destroyed by global warming." He read that in the book of Matthew. Now, you know, I'm a little nervous about that. I don't know what Luke and John had to say about this, but Matthew evidently said, you know, John, don't worry about it. Luckily, he did not. He was actively trying to get appointed. He wasn't, but Fred Upton was, who happens to be the representative from Southwest Michigan, and Fred's a little more reasonable. But my point is, I'm trying to tell everyone, this is cool, you know, this is where the action is, and then after the election, cap and trade looked dead. The EPA new initiative, March 2011, may not get funded to map the, you know, the big footprint, 250,000 metric tons or more. Then we talked about the Carbon Disclosure Project, which Sandra knows more than I do about it. And the Carbon Disclosure Project is a archive to gather data. We said there's over 2,500 companies reported. PricewaterhouseCoopers is the advisor to the Carbon Disclosure Project. Its mission is to collect, distribute high-quality information that motivates investors, corporations, and governments to take action to prevent dangerous climate change. It acts on behalf of 534 institutional investors whose portfolios are $64 trillion. So the managers of these portfolios want these data when they make their asset allocation decisions in their investment portfolio. And it's also 60 purchasing organizations like Walmart and Cadbury. And so they gather data on carbons, all kinds of risk, opportunities, emissions levels, scope 1, 2, and 3. You know, scope 1, 2, and 3 are like Notre Dame scope 1 is we got this big power plant burning coal. You know, that's scope 1. We're causing it. They drive a truck from South Dining Hall to business school to have a luncheon. You know, that's scope 1. We're sending those greenhouse gases directly into the atmosphere. Scope 2 is, well, we don't generate all. We buy electricity also. So when we're buying other companies' power, the carbon footprint of generating that, scope 2. And scope 3 is all this other stuff that's Bill Nichols has to travel from Niles to Notre Dame every day. You know, what's the carbon footprint? Or I'm traveling for Notre Dame to go to a conference. So that's scope 3. The Carbon Disclosure Project, you can get any of these data by logging on and just getting a user ID. They do it by company. They also aggregate it, you know, like Global 500, S&P 500, FTSE 350. And beginning this year, and Kellogg's did it, God bless their soul, there's now water disclosures. And that's big. That's big to someone like Kellogg's. What in their supply chain is the footprint on the use of water? Because it's agriculture. You know, their cereals are made up, well, of sugar, but there's all, you know, that's agriculture. But, you know, corn and wheat and all those types of things. So 59 U.S. companies out of the, there were 75 companies that gave data out of the 2,500, and 59 of the 75 were U.S. They've set this up, and we don't know much about it, but there's something now, like there's the Financial Accounting Standards Board, the International Accounting Standards Board, there's the Climate Disclosure Standards Board. They issued their first document in September, and it's kind of like a conceptual framework. So, I mean, they're just kind of figuring out where to go with this. But it is a marriage of some big hitters. On the boards, the CDP, the Carbon Disclosure Project, the World Resources Institute, Ceres, which is a huge social corporate responsibility NGO, the World Economic Forum. So it's something to watch. Now, cap and trade, I see the time. Cap and trade, I thought was really slick, you know, and I kind of took a hit in the stomach after the change in the election. So we talked about the nature of the beast. We talked about the U.S. experiences and prospects for the future. And actually, the prospects for the future I thought were really bleak because of the election. But now I don't think they're so bleak because businessmen and women tell me, no, that was positioning. That was a lot of policy stuff. That there's so many regional initiatives. For instance, in California, anyone from California, you know, on the ballot in November was postponing the Schwarzenegger had Assembly Bill 32, which said we have to reduce greenhouse gas emissions by this % by 2015 and something else by 2020. On the ballot was to postpone that until unemployment rates got below 6%. So good luck. And that was defeated. So that's still law in California. If California goes with that, there's some provinces in Canada that are going with them. There's 11 states out in the Northeast that have got their own cap and trade only for utility industries. And so what I'm told is, even though things like the Chicago Climate Exchange went out of business in December because they didn't think they could sell, you know, they could sell allowances. What I'm told is that businesses are going to have all these different regions coming up with unique laws, and so they're going to go from the ground level up to Congress. This is a bunch of baloney. I need one U.S. standard. I can't, you know. So there is some hope. Then the EU experience, we talked about that. Their trading scheme. There is no, this is slick. I mean, if you like, damn it, there's a lack of joint accepted accounting principles on how to account for this stuff. And it's unbelievable, and if you're into accounting, it's like heaven. So don't read this, but the thing is that you get these allowances under cap and trade in the EU. You get allowances to send a ton of CO2 equivalent into the atmosphere. Some of the allowances are granted and given to you by the government. Some of them you can buy through purchasing, like on an exchange, like Chicago Climate Exchange. There's exchanges in Europe. And how you account for these things is bizarre. I mean, how do you recount, if they give them to you, you purchase them, do you record them at fair market value, at cost? How do you set up the liability? Because you have to give so many allowances for admissions. You know, if you record it at fair market value and the fair market value changes, does that go to income or does it go to some other place, like accumulate other comprehensive income for our accountants? So the accounting for this is unbelievably interesting because there's so many definitions. You got to think of what's an asset, what's a revenue, how do you report these things, how do you evaluate these things. Then this is where the class I think was the weakest, and that was how do we use these data in a investment decision? And you know, we looked at the United Nations Principles for Responsible Investing. We saw all kinds of surveys that said individuals and institutional investors do care. We saw all kinds of, like the Dow Jones Sustainability Index. We looked at all these indices. But here's the problem. It's hard to get my arm around a comfortable feeling about the effect these things have. Is there an effect on security returns? In other words, if you buy companies that are what we would call socially responsible, do you pay a price at a reduced return? Or do you have a higher return or just about the same return? And it seems the data out there that I saw are, well, I don't think you're being punished. But, I'm not quite sure. So this is what Heather did yesterday, okay? So Heather was here and talked about sustainability at Notre Dame. All I'm saying is part is stars, and that's what Notre Dame has gone from the report card system, which was very much driven by universities with large endowments. They're going to now file under STARS, which is Sustainability Tracking Assessment and Rating System. There are very few schools that are doing it. Now they're jumping on the bandwagon. It's new. It looks a lot like the GRI. It's got a lot of things to do with operations, energy, building, has planning. And so the point I put up here is we have 3 MBA students right now working on this project with Notre Dame because they know nothing about how to do this. And so they've turned that over to the Notre Dame MBA students, the 3 of them, because one of the things that goes into STARS is looking at education and research. Like, what does Notre Dame do in their research activities that addresses these types of issues of sustainability? And in education, so things like the curriculum, the research of faculty. In our college, because we do through the great pinstripes, the Aspen Institute, we have to show what type of classes and research we do. We tend to gather those data. But in other entities, they don't gather them. They don't even know where they are, and they probably don't care. But I think they're going to care because the university is very interested in this is not only a report. This is everything else has been a report, but this is a game where you have to earn points, and you can be bronze, silver, gold, or platinum. So Notre Dame at the end of the day wants to be something higher up in that list of medals. So guys, we finally got to the end. So thank you. Oh, that's the wrong direction. Okay, well anyways, whatever. I want to show you the thank you. Okay, thank you. If anybody wants the PowerPoint slides, send it to, wnichols@nd.edu, and I'll send it to you. Okay, thanks.
Any last minute questions for maybe one? It's a good one before.
Yeah, it's interesting. The GRI, how robust it is a question. For instance, out of that 1,389, there's 6 universities, like 2 in Germany. There's 6 universities. They've just come up with they have 5 guides for particular industries, like utilities, and one of them is for municipalities. So I think some cities are, but governments at that level, but not beyond that. No, but there are cities now that are going to try to. Pardon? Yeah, and all I know is what they post on their website, and private companies may not post. In other words.
Yeah, I wonder if they're sort of getting away with not doing it because they say, well, we don't provide financial information, but there's all this engagement in document social responsibility. That's everyone, right?
Yeah, no, you're right. Yeah, the impact they could. Yeah. And even some things, you think of a city, even some things you have to report is crazy. I mean, things that, do you have a policy on how many months notice you need to give a city if you're closing a plant down? They have all kinds of things that are like that. Yeah, no, yeah, well, yeah, a lot of what we talked about is environment. And I'm more comfortable with that because I can kind of understand it. The social stuff's harder for me to get my arms around. But yeah, the carbon, I think carbon's, even if there is no such thing as global warming, it's just a trend, it still seems to be, like I'm a grandfather, I have 4 grandchildren. It seemed nice to leave, the cities a little cleaner so you don't choke. And I mean, and to be more responsible about disposal of things. I mean, I find myself feeling guilty now. I mean, I don't have styrofoam cups. I hate styrofoam cups because I live on the river, St. Joe River. I see them floating down with tires all the time. But I find, I worked out this morning. In the old days, I'd grab 2 towels because they're sitting there at the jack, and wipe off. Now I would never use 2 towels. I use 1 towel. And I went to a talk. A guy was doing sustainability. Said, "There's no reason why you need to shower every day." No, I'm not at that level. He said that's just a waste of water. I'm thinking. Yeah. Yeah. And that video is on YouTube.
Thanks so much to Bill. Please join us tomorrow for Sustainability and Marketing, Thursday, Sustainability and Wind Energy. Thank you.